Hello, this is Steve St. Angelo from the SRS Rock Report. Really glad you're joining me today because we're welcoming Bob Coleman from Idaho Armored Vaults. And we're going to talk about what's driving the prices of the metals to new highs. Gold hit new highs today. Silver hit new highs since 2011. But first off, I want to say I've known Bob in the industry for quite a while, but I got to know him after the pandemic shutdown in 2020 when, as you remember, Bob, we had some crazy things happening with the premiums, with the demand, when skyrocketing demand, a lot of things going on with the analysis. And we got to talk about, I shared things about energy, and you really shared a lot was going on in the markets that I didn't know about. So, Bob, thanks for coming. How you doing today?
Good, good, Steve. Thank you for having me on.
Well, listen, let's start here. Because you've got Idaho Armored Vaults, you're also a precious metal dealer. You have a hedge fund in precious metals. What do you see going on with these new price spikes in gold and silver? What do you see happening like in the last week with the physical buyer?
Yeah, I think if you're looking at the retail market, you're seeing, I think the smaller guy has been sort of selling into the market where it's been the same mantra as the larger investor. Maybe someone buying $100,000 or half a million, yet they've been kind of coming into the market being as either maybe a new buyer or someone that may have already a little bit of metal, but they're just saying, hey, listen, I don't trust very much anymore or anything. I see everything that's going on TV and all political discourse and so that I think there's just looking for some type of store of value, some place to kind of take the chips off the table, park them somewhere. And the metals kind of make sense, given the federal deficits and all the spending that's going on, and of course a lot of the political rhetoric that we see, from not only from leaders of our country here but around the world. So I think it's just this uneasiness, and just that concern that says, hey, listen, I saw for example, today I saw a stat that the top seven companies in the United States have now over a 20 trillion market cap, which is actually bigger than China's GDP, which amazing number. I mean, it just this thing just continues to kind of just grow in terms of asset prices and so forth. And so I think people see all that and they're just saying, listen, the metals have been around a long time, and they're going to outlive me, but they won't go to zero. And I think it's that simplicity. That's, of course, obviously the price is also a driver too. People, price attracts money too.
So, how would you say the market is different compared to 2022, 2023 to today? Well, just a rough idea, because I think some people still think there is buying in different parts of the world. There is buying, but what do you see going on, let's say, in the United States?
Yeah, I think back in 2022, you had this sort of um, bottoming out of the metals, where all of a sudden the price sensitive countries like India and China started to walk into the market as sort of US investors after the 2020-2021 fiasco with silver squeeze and so forth didn't pan out. So you had this sort of a little bit of throwing in the towel. You had managed money that was shorting the market down, ready for the interest rate hikes and so forth, and just kind of playing that macro playbook that says, okay, it's time to get out of metals. Well, and you went into this backwardation and so forth, because of all the foreign buying that was buying in the physical market. And that was back then. In today's world, you have serious contangos, because meaning the futures price is now higher than the spot price. And because the interest rates are plus 4%, it's very natural to see that. It's just a time value money thing. But what you have seen that you didn't see back in 2022 was this growth of ETFs. The investor, the trader mentality has been seeping into the market as prices have been rallying. It's this old adage, sort of momentum chase price, and then the price goes up and that attracts more money. And so you got this sort of momentum trade that's been kind of powering higher. At the same time, a lot of the shorts that are in the futures markets, maybe in the mining stocks, whatever it may be, they've been trapped and obviously been getting squeezed out of this market, and that's been what's also been powering the market higher. Even though you haven't had as much retail physical demand like maybe you saw in 2020 through 2023, that really was never a driver of true price. It was more of the larger institutional investor, as well as the unfortunately here in the U.S. the futures markets dictate a lot of this price action, and you're seeing just the open interest has been sort of flattish. It's been picking up on gold, but it's been kind of flat on silver. But it's basically this sort of squeeze on the short side that's forced these prices higher.
Yeah, because you see, that was my next question. And when you and I talk about this, we get on the phone. It's like, what is driving the price? Because if you look at the overall, like the World Gold Council, we're not seeing a huge increase year over year of demand overall. We are seeing more investment demand in China, and central banks are buying more gold. And in silver, there isn't a huge increase year over year in silver physical buying. But from talking to you, you've told me that it's what's happening in the futures, the over-the-counter market. This tends to be driving the price right now. Could you explain? You did explain a little bit about that. Could you explain a little bit more why is that the main driver right now?
It's a big part of it. You have to understand, with the advent of Wall Street getting into any asset category, whether it's Bitcoin with the ETFs, for example, or AI stocks, whatever it may be. When money starts coming into a sector, it not just goes and buys the underlying asset. It actually it spreads that money out over various different products, options, structured products, whatever it may be, and that starts to lift sort of the tide, and all of a sudden everything kind of floats higher. So mining stocks start to go up. That attracts more money. That money, and then you get money going into more ETFs, more open-ended mutual funds. It's just capital flows coming in and trying to find anywhere that has gold or silver, for example, associated with it. Money's going to fly there. So like there's gold and silver ETFs that actually don't even invest in physical gold and silver metal. It just invests in the futures of those categories. And that sees a lot of investor or a lot of capital flow. So, and that goes into the futures market, starts buying futures. And so you've got this sort of, it's almost like a frenzy that starts to develop. Obviously Bitcoin was a much more pronounced sort of momentum driven sort of surge. But the nice thing is with the metals, at least our corner of the world, you're seeing that recognition that yes, this is a store of value, right. And yes, it does attract and does have some importance in the financial system itself. But I think that's the underlying theme is yes, the derivative markets can have a huge impact, I think, on just the price action of the metals, because you have to understand in the financial side of the industry, when it comes to gold and silver, it's not just simply retail buying and so forth, and bars and coins that make up the market and push it around. You're talking the large 1,000-ounce bars of silver, and then how those bars, or how the industry through the authorized participants with ETFs, through the swap dealers, through wholesalers, jewelry companies, fabricators, whatever it may be, all these players have influence into the markets. And you may be seeing obviously like a lot of industry demand for silver, whether it be for solar or for photo, for electronics, the big talk about battery, potential solid state batteries using silver. All these types of things start to build sort of interest, and then all of a sudden there's stockpiling that's going on. So let's just say, take for example this silver battery that was talked about, I think about a year and a half ago. If that actually is going to come to fruition, maybe not on a massive scale initially, but there's a stockpiling that has to be done in order to get that. That's going to be done over time. You just can't go into the silver market and buy 100 million ounces overnight and not expect it to affect the market. So you have this, the market makers, for example, will go into the market, and they see all this investment demand. They have clients that are trying to position themselves into the markets, and that's where the market makers may help sort of manage the market so they can get their clients positions built up without squeezing the price higher, for example. So you get this, volatility that happens, day to day, where maybe, the retail, you see it a lot on Twitter, where you get this sort of bankster sort of mentality of
Right.
driving the price down, at a specific time of day or in the middle of the night. But some of that actually could just be positioning by market makers, shaking the market a little bit, so they can, or just players like, large hedge fund managers or portfolio managers that are trying to build a position using price action to maybe help themselves, uh, you know, take the position in, whether it be options or in futures or in mining stocks, whatever it may be.
Now, you just talked about that aspect of the market, and you've got a great chart. This is what I like about you, Bob. You are one of the few people, and this is Bob's Twitter feed here, Profits Plus. You should follow him on Twitter. And back in February 16, 2024, you said we could be on the verge of a mother of a short covering for silver. And then that was in February 24. And then back in July 25, you you said the same thing because Daniel Golly, who works at TD Securities, he was talking about the silver squeeze that can be buying into. What what was it? This is part of the machinations in the futures market, in the silver market. That what did you see going on this early on that eventually turned out to be a silver squeeze, and that silver squeeze continues, doesn't it?
Yeah, and have to remember, for listeners, I've been in the markets since 1992. So I've seen a lot of bubbles. I've seen a lot of crazy stuff. You see the sentiment. You see different types of technical indicators and measures of the markets over time, and you could kind of get a sense of, okay, when are we washed out? When are we, it's too exuberant, for example? When are things maybe getting close to a potential top, whatever it may be. But back in early 2024, when I saw this market sort of developing, you saw the frustration from retail, you saw the frustration in social media, you saw the buildup in managed money on the short side. There was absolutely no trust. I think you just came off of the silver squeeze movement that basically, most online dealers, most dealers in general, a lot of them vastly overcharged for products. Clients, or a lot of precious metal buyers, starting to realize they paid way too much for premium for a lot of these products out there, and so you started to see sort of the frustration develop there. Those are all setups, and then you start watching sort of the Basel III and the deleveraging that was happening in that market, the banks getting out of unallocated positions because there was sort of this reaction of reserve requirements that they had to post that was actually intrusive to doing these unallocated type offerings to their customers, where they had to post basically 85% of the value of if the client says, hey, listen, I want to buy gold, and the bank used to say, listen, well, I have this unallocated product, you don't have to pay any storage fees, and you get the price action of the gold. Well, what was happening there was the bank was backing that unallocated position by the bank's balance sheet, not by actual allocated gold. So Basel III came in and said, listen, if you're going to do that, you've got to put aside reserves to protect your balance sheet. And so you started to see the banks sort of unwind from a lot of the unallocated type of stuff. But yeah, you had the growth of ETFs and the advent of authorized participants and the interaction with market maker as market makers, the interaction with that with capital flows and so forth. These are all having this is that buildup going into 2024 that I started to see that, okay, wait a second, you've had basically the worst sentiment out there. At the same time, everything that we've been talking about probably for 10 years, since the financial crash and so forth, was actually starting to develop. Deficits were exploding. You just come off a rate hike cycle. Liquidity was starting to grow again. All these types of things were starting to factor in, and retail just absolutely did not trust the market anymore. They started to sell on every rally. Listening to a lot of these promoters out there saying, "Oh, the banks are just going to smash it down when silver hits 26. It's going to go right back down to 22. It's never going to go anywhere," which I think was, you know, it was odd marketing, because the marketing was to try to get the retail to distrust the system, so they would buy silver, thinking that they could actually, somehow push the market higher if all these retail investors got together and started buying 1 ounce rounds at $5 over spot. But what ended up happening was the dealer industry got fabulously wealthy off of that, and now that silver is starting to get over $40, a lot of these people are starting to finally make money. They're starting to build out a return over the premiums. But now what's happening, and we can get into this later, is the spreads are widening and the bids are getting worse and worse. Meaning, when people want to sell back and take profits, now they're getting $2, $3, $4 under spot. For a lot of these silver products, they paid $5, $6, $7, $8, $9 over spot, or even like Silver Eagles, which they paid $20 over spot. Now a lot of these dealers are paying a discount to spot for the same thing. So there's this massive spread that they've had to overcome, and that's also, I think, when you talked about earlier, there's not a lot of coin and bar demand. This last year and a half, you saw about 100 million ounces sold back into the market.
Yeah.
A lot of that is just the investors saying, "Listen, a physical product makes no sense the way a lot of these guys sell it, because I have to overcome too much of a cost barrier just to make any money at it."
So with the price going up very quickly now, so I think the futures price today was over 43. It's $43.20. A lot of people you see in social media, they're pushing it. We're going higher. We're going to 50. We could go to 50. We're going to 70. We're going to 100. What do you think is a more rational way to look at it? Of course, no one knows the top, right? But what are you feeling when you're seeing these prices move the way they are and where we're at right now?
Yeah, I think, I always thought $50 was sort of a magnet at some point, because it's hit there twice. You've had this sort of cup and handle formation on a longer term chart. You've had, this, with gold hitting new all time highs. It's not a far stretch to say, listen, what other precious metal hasn't hit an all time high, or that's, maybe on an inflation adjusted basis, maybe not at the spike back in 1980, but maybe an average price. How much more could another metal go that gold already has gone? And I think I saw a quote today, that gold finally hit its inflation adjusted price peak back in 1980. It just hit that today. So people look at all this stuff. I mean, these are just natural things people are inquisitive on, and I think, it's not it wouldn't be a stretch that I think when we get into the final bull phase on silver, if you do have the dollar dropping and the mistrust out there, yes, it could go much higher. But I think, initially my guess was that we'd probably see, $65 or $70 potentially on some type of surge higher in silver, and then I think, as this whole market melts up, eventually you're going to get, I think, this, maybe there's an event out there, maybe inflation picks up, maybe that's what pricks the bubble, who knows. But then I think, you could get this sort of big pullback, just in the general markets, and that could certainly have an effect on silver and gold. But then the question obviously after that is, well, the markets take a big drumming to the downside, like 2008. Well, the Fed will be forced to come in and try to help bail everything out again. And at that point, the question then is, do we get this potential dollar, sort of this dollar devaluation real concern that starts picking up, in the ultimate run? This is, I try not to look too far ahead because it's like driving down the road in the middle of the night without your headlights on.
Right.
You don't want to be, looking, beyond the turn, and then all of a sudden, get smacked right off the road, before you get to your end location. So it's just taking it step by step, and that's what I try to do, watching market structure and trying to say, okay, let's not get too ahead of ourselves. Let's just try to understand what's happening on a day-to-day basis.
Yeah, and because I've seen, you use some tools like I've seen this. You've been putting this out recently, the gold volatility chart, and basically you've got two of them here. I think one was on August 28th, and the other was on September 7th. And what you're showing is the gold price in the red line, and then the volatility is in the blue line. And it seems as if what you're seeing when you check these technicals is when that gets in a real bullish wedge downward. When it breaks above it, it tends to we see the gold price move up. Is that what you're showing here in these charts?
Yeah, what we've kind of had was, every market has a different sort of structure to it. And what we've seen from 2024, and potentially a little bit sooner before that, is when volatility rises, it tends to have a very strong move or strong positive move for gold. The gold market has some sort of, there's almost like a pressure cooker, and when the price is basically that steam that's relieving the pressure, I should say, as a pressure cooker. I mean, there are times when gold volatility goes up and then all of a sudden the price goes down. There are definitely times like that as well. But, what we've seen is, I think this is probably due to the options market more than anything, and trading desks that have been looking at gold vol or volatility in the general markets and overall, and trying to use derivatives to try and capture volatility. You see a lot with gamma and delta hedging and all those types of things that market makers use. Well, the gold volatility ratio is nothing different than that. But it's trying to capture the potential for when that move is going to actually happen. It seems like volatility has done a good job of the setup before that actually does happen.
And does it ever give you an idea of when we could see a price decline? Does it provide that information too? Is it mostly it gives you an idea of when prices are going to increase?
So far, it's been more on the price increase side. I mean, you
Hmm.
certainly have had where all of a sudden the volatility drops and the price of gold drops or consolidates. You certainly have seen that. So you could say, well, after a big surge in volatility, you could almost say, well, okay, the prices have gone up, X%. Now it's time for the pullback, or consolidation. Volatility works its way lower again, and potentially some of that is, due to market maker interaction, or in the futures markets, whatever it may be. You see a lot of this with SLV, the interaction with authorized participants, taking positions, or market makers taking positions. When people buy call options, for example, market makers will sell calls to the retail public, and then they'll go in and they'll buy the underlying position as their hedge. And typically most calls go worthless, and that's due to the professional community. I think, that's part of the market maker, yes, sort of the impact market makers have in the general market. But all of this has to do with positioning, sizing, all this types of regression and so forth that happens partly because of the options market. And the options market has gotten so big now, and it's having such an outsized effect, especially with options that are zero DTE, daily expiring
Right.
options. I mean, it's become a massively huge market. Structured products have become extremely popular, meaning structured products is, banks will offer, kind of like what you saw with the Big Short, where the guy says, listen, I want to short the housing market, write me a contract for that. And so like in the structured product market for gold, for example, so let's just say an institution says, listen, I want 80% upside of the gold price, but I don't want any downside risk. Well, banks can create an option strategy for that investor. Um, and it's very lucrative for the bank. They make a lot of money on fees doing that, but it gives the investor, some type of ease, I guess, getting into a market environment. So that all these things impact pricing and volatility and other structures out there.
Yeah, and I don't think a lot of, let's say, retail investors, I don't think they really understand the complexity. I didn't until I started talking to you. There's a lot of complexity going on in the futures market, in the options market, in the over-the-counter market. And so when you see a huge price drop, it tends to be, people said it's manipulation, but it's a lot of these things happening with these large entities, large participants, correct?
Yes, and that's part of the frustration that I kind of see out there with the retail environment, trying to make this too simple, or the newsletter writers, the bloggers, the promoters that are trying to make this very simplistic for the individual to sort of. It's kind of like they're creating the mousetrap, or the the light that's going to attract the moth, or the flame, I guess I should say. um, they make it very sound simplistically, what's happening in the market. This is just, the banks coming in, shorting the piss out of the futures markets, and eventually they're going to get, they're going to get squeezed, and the market's going to go a lot higher, and there's billions of dollars of naked short futures contracts out there. But what they don't understand is how the activity all interacts with the London market, the spot forward pricing, futures markets. All these types of things are sort of a living, breathing type of system. So when one player comes in, like for example, we saw earlier this year when you had some very large players come in, large retail or high net worth individuals come in into the silver market and buy it up. Um, that was probably partly what pushed the EFP, the exchange for physical premium, out of whack, meaning they came in, bought so much that the hedging that needs to be done by the industry when a player comes in and buys physical product, the industry will actually hedge and buy the futures market when the retail's buying the spot market, because they have to have some sort of hedge because they're selling that product to the customer, so they have to somehow hedge that short sell that they just did, and they do that by buying the futures market. Well, that tends to blow out the EFP, or that futures price versus spot price, for a very short period of time, because a lot of times when these big players come into the market, um, uh, they call a dealer up. The dealer will call 4, 5, 6 different suppliers or wholesalers or banks, and all of a sudden everybody on the street knows this guy's looking to buy. Well, what does Wall Street always do? It's going to raise prices. If the person wants it that bad, they're going to pay up for it. And
So
so this is
let me jump in and ask you this: the exchange for premium, or for physical exchange for physical, is that similar when you get a big players come in on the spot price? It pushes it up. Is it similar overall to when a lot of people are buying metals back in 22, 23? You saw premiums go up on the actual bullion product. Is it, to keep it simple for silver investors? Is it a similar kind of principle that's in the futures market?
um, somewhat, but the premiums on spot product, like coins and bars that you're talking about back in 2020, 2023, that time frame, that was greed. That was partly the 1,000 ounce bar. The price for that 1,000 ounce bar went from 15 cents to maybe 85 cents on the wholesale level, because of the tightness that was developing, not necessarily a shortage of silver. Just back then you had social
Mhm.
distancing. You had the inability to make, or refine as much as you wanted to refine. So you had that sort of uh, uh, friction in the market. Well, what happened then was, the price went up, the cost of refining went up a little bit, fabrication went up, and so what happened was the retail industry you have to remember 2018, 2019, the retail industry, the wholesale industry were all losing money. The market had really slowed down. People were selling, they were frustrated. So when 2020 happened, it was a way for the industry to say, well, wait a second. And it started off actually with retail. It wasn't really the wholesale side that started pushing premiums up really fast. It was actually the retail side seeing this massive demand come in a very short period of time. All of a sudden, it was almost as if they just decided, okay, let's see how far they're willing to pay for the product. Because I was selling the average silver product, any silver product out there, $2 to $5 cheaper per ounce than anybody else that I saw on the street. I mean, that's every big online dealer, even local coins. I had local coin dealers calling me from all places in the United States trying to get product, and prices. I was offering some of the product cheaper than some of the wholesalers out there because I was just, I was buying from some of the biggest guys in the marketplace. But what was happening there was just a pure markup. It wasn't like the futures markets where you have time value of money, you have
Right.
other factors that come in and distort price modeling and so forth. In the futures markets, in exchange for physical, which is basically a spread between the futures price and the spot price, things can affect that. If you have tightness or lease rates go up in the London market, the spot market, or physical market, that the cost of carry or the cost of obtaining that metal rises. Well, the futures markets kind of play with that a little bit because of it. All of a sudden, the cost of potential carrying costs start to rise. All of a sudden, that has to be factored into potentially the future price of money or the time value of money when it comes to the metals. And so the futures price may try to lift off of that. And then you also have, if the price goes down, like for example, in 1980, when the price went to $50 an ounce, and people had junk silver, for example, back then, the refiners were only willing to pay $38 when spot price was at $50, because the
Hmm.
reasoning behind that was there's so much potential supply coming back that the refiner said, listen, we're going to price this out, 6 weeks or whatever, when we can get to it. And we don't think the price is going to be $50 in 6 weeks. We think, it may pull back. And so we're hedging that. And so you see this type of interaction in the markets, and it's not manipulation. It's just players in the market that are pricing based on certain uh, uh, outcomes. If that makes
Now,
sense.
yes, and you brought up a lot of the metal silver is being sold into the market. And I wanted to look at this. And one of the things we hear about in the metals community is a difference between the metals community and then the precious metal industry, which is their professionals, the banks, but the idea, Bob, is that since Trump was elected, we saw a lot of silver and gold move into the Comex inventories from across the world. And I mean, they're hitting new highs. This is the Comex total depositories. There are 527 million ounces. And the next one here, this is the registered silver. It hit 200. It's down now, but we're seeing a record amount of silver held in the registered silver category. And there's a notion that there's a draining of the Comex, or there's been massive deliveries. A lot of this silver's been taking off. So it's kind of a confusing message to the precious metal investors. Can you explain really kind of what's going on, and also talk about the registered silver, why it's different?
Yeah, on the deliveries, a lot of people focus, and you have to remember when you're talking about the industry, especially on the financial side, there's a lot of confusing terms. So it's easy to get some of this stuff really confused if you're sort of novice to it. And I see that a lot. So the delivery reports that a lot of people gravitate toward are actually not the physical delivery that you would think of. It's actually the delivery of warrants being traded back and forth from clearing firm to clearing firm. So think of it as like in the stock market when you're trading the old-fashioned stock certificates on the floor. That's those warrants or those certificates are just trading back and forth. So the metal sits in the vault and may not go anywhere, but you may have this turnover of certificates that makes it look like something's happening, but in reality, the silver's still sitting there. So in essence, what I've learned over time is there's a lot of times the delivery reports don't have as much actionable information as you would think. It's kind of like going down rabbit holes. Whereas if what I've looked at is more on the stock reports, which is still put out by the CME or the Comex or the NYMEX if it's platinum, Comex if it's gold and silver. But the stock reports tell you the actual physical holdings in the registered category, which is the metal that actually backs the futures contracts, and then also the eligible category, which is basically silver that is eligible and meets all those specifications. That's 1,000-ounce bar. It's made by a specific refinery that can be put on receipt to then be used to back a futures contract. But these are just eligible bars sitting in a private account somewhere. So think of it as just metal that's kind of collecting dust. It's not really doing anything versus the registered category, which is actually backing the futures contracts.
So when we see a chart like this, when we see a chart of the record amount of registered silver, does this suggest to you a tightness in the market? Is there a tightness in the silver market? What would you, if you looked at this? I mean, look how much it's gone up since 2025. It was 80 million ounces. Towards the end of 24, it's gone up almost 120 million ounces in about 8-9 months. When you see this, what should a silver investor understand from a chart like this?
Yeah, this you're going down the right path here, and this is going to go. I mean, hopefully, it doesn't get too complicated, but we'll walk through this. Right now, at face value, there's plenty of silver out there. If you look at the stock report, you say, well, God, there's 200 million ounces in the registered category. There's 500 million ounces in both the registered and eligible category. What's the big deal? What you have to understand is a lot of banks bought a lot of metal early on in this in 2025 at the end of 2024 as well, when the tariff issues were being discussed and so forth, and people were uncertain. Well, God, if I have all this metal, if I have real Canadian mint bars sitting in London, and all of a sudden Canada has a tariff on it, and I'm short a futures contract, and I have to deliver that metal that's sitting in London that happens to be hallmarked by a country of origin, which is going to be tariffed. All of a sudden, I haven't hedged for that, that potential loss where, you bring in $1 million of metal, and all of a sudden it has a 25% tariff. And now I have the $250,000 expense that I have to meet at the border to get the metal to the futures markets to then settle against my short position. That was what was causing a lot of this concern out there. And so you had the banks were buying a lot of metal, delivering onto the exchange, and then and as you have this big sort of concern and I guess worry out there, the people that were short were frantically trying to cover and close out their positions because they were worried. Well, listen, I can't get silver if it's sitting in London. It takes 30 to 60 days to get it on a boat and send it over to New York. So some people were just closing out positions. So that created this EFP situation where it blew out. It went from maybe 15 cents or 25-cent premium between the spot price and the futures markets to 85 cents overnight. So what banks did was they bought a boatload of silver, for example, if you're just looking at silver, and they did with gold too. They bought the physical, delivered to the exchange, and then they sold that elevated futures price, that spread between futures and spot. They sold that elevated price and made a risk-free arbitrage profit off of that. Meaning, the first I think it was first quarter of this year, you saw banks making, I think, $500 million buying silver, for example, and gold, deliver it to the exchange, and selling a futures contract against it. So so what you have now is you say, okay, well, the 500, the 200 billion that's sitting in the registered category, this is where it gets a little complicated. There are futures contracts written against that metal. So it's not that it's 200 million ounces that could come right out tomorrow. Most of the lead month contract now for silver is December contract, and the December contract is when, if you want a December contract, that's when you can actually take delivery if you're long, and if you're short, that's when you can deliver metal to the exchange. You have till December to do that. So what happens is the metal is sitting there, but it's locked up, and this is where the sensitivity to tariffs, the sensitivity to leasing rates, and cost of carry and so forth start to factor into the equation. And this is why I watch a lot of this stuff, because it tells you when, for example, the cost of carry or leasing rates of silver start rising. All of a sudden, it has outlying effects. You watch the cost to borrow SLV shares, for example, start to rise as well. These things all start to play into the market. Options markets you start to see the skew and so forth become mispriced, maybe more toward calls than it is to puts. And so all these things, and then you have the gamma issues and the delta hedging and so forth. All of these things start to seep into the market and start to, almost like water, it starts to flow wherever it's path of least resistance is, and you just watch some of this stuff develop. And that's what I try to do every day when I'm watching this stuff, is say, okay, where's the pressure, and where's that pressure going to push on, and where's maybe the price, where's the relief valve going to be, and that's what I try to help dispel in some of these quotes and tweets that I do. I know most people go, my God, I don't understand a word you're saying when you post some of this stuff. Just tell me if it's going to go up or down.
Well, that's the thing, but I really dig deep to find out what's like the cost of production, because I really never knew, Bob, what was driving the metals prices, and no one really gave me a good understanding until I saw over a 50-year period. They tend to bounce off the cost of production, and that tends to be most goods and services. I'm not talking about land and things like that, but what's fascinating, we both. I love the precious metals, but I tend to like silver more. I think silver is probably going to outperform gold in the future, and that's due to my energy constraints kind of message. But what I wanted to share here is I've noticed this, is that we're seeing Indians they have been physical buyers. Americans buy coins and rounds, but it's the Indians basically buy a lot of bars. That's their big buyers of silver bars. But now they're not only they're buying their own coins that are being manufactured there, they're also getting into the ETFs. Now I know there's caveats into these ETFs, different ETFs, but what do you? I think one of the things I see a telltale sign is when we see that the Indian silver ETFs have grown 29 million ounces since the beginning of the year. That's higher than the SLV and the Sprott PSLV. So, just what are your thoughts on these different dynamics that are taking place in the silver market?
Yeah, I think a lot of people are trying to figure out the most efficient way to buy metals. And I think, with the India, you got to worry about, the tax ramifications of taking physical. A lot of times potentially there's a markup on physical product or jewelry, whatever it may be. And so sometimes, and that's the allure of the ETFs, is that, the investor, the traders could say, listen, I don't have to worry about premiums. I don't have to worry about these wide spreads. I could just put my money into these things, and if the price of silver goes up 20%, I'm going to capture most of that 20%. It's not going to be eaten by the dealer, and their big margins. And so that tends to help the investment community and trader community. But what part of that, though, is the interaction with the authorized participants with these ETFs, where the clients would probably see a bigger return if they actually went into the actual physical metal, rather than going into these products, because the products are heavily um, let's say, influenced by the market making action of the authorized participants. The authorized, most people think that the ETF is the product, but in reality, the client is actually the product for the flow of the ETF itself, if that makes sense. So the authorized participants will go in when it's at a discount to NAV. They'll look to buy shares on the cheap, deliver those shares to the ETF, and then get actual physical metal or the overpriced metal or higher priced metal back. And so that they can make money on that arbitrage. And just like when shares are very expensive or at a premium, authorized participants will sell shares into the market, overpriced shares, and grab, the they'll deposit metal, create the shares, and then and with that spread between depositing metal and the higher price shares, they can sell those shares at a premium to what that actual silver was going for at that moment. So there's a lot of that goes on, and I think that's where some of the retail and promoter industry says, "Oh God, there's manipulation," and they point to the banksters right away. But in reality, some of this has to do with the market makers and authorized participants and their simple interaction into the marketplace. Now, the one thing I think it's important, I think you brought up something very important, which is the cost of production. And I had someone that over the weekend was asking about, what does cost of production really have to do with the price of silver? For example, if all of a sudden demand is going crazy and everyone's buying it, isn't that just going to simply push the price up? And why do we have to worry about cost of production? What I think cost of production, and you'll probably agree, matters more in a bear market than it does in a bull market.
It's a
And,
floor, right?
yeah. And you've done a great job of identifying this cost of production, I think better than most people out there, and especially with some of these charts. And so what I try to look at is, okay, it doesn't really matter right now when there's money coming in and capital flows are driving price action, and you have industry coming into the market buying whatever they can find. This isn't when you want to use that analysis. That analysis comes into play really when you're trying to look for these massive profit margins relative
Hmm.
to historic profit margins like you do. And I think that's just something that's good for us to kind of talk about, because I think people do have that kind of question of, well, what does all this stuff really matter when you talk about this or that? And just to put that, in the stock market, there's an old saying, in a bull market, income statements matter. In a bear market, balance sheet matters.
Hmm.
And so in our world, when we look at some of these things, especially in the mining industry, you want to look at cost of production. You want to look at profit margins and so forth. What we were talking about this before, the inputs going into a mining company right now, they're really in a perfect world. Oil's
Yes.
low. A lot of the input costs are low. Well, what happens if the input costs start to rise,
Well,
even if gold starts to rise more? Well, the mining stocks could actually pull back, because this gross profit margin will actually start to decline. So those are things that people do want us to try to think of.
yeah, and I appreciate you sharing that because I always looked at the cost of production as kind of and for a long time in the 90s and early 2000s, silver remained about the cost of production, four and a half, $5 an ounce. So for 10, 15 years, it didn't start rising until the oil price went up to 2007, 8. And so, yeah, it gives us an idea of where the floor would be. But I've said this many times, is that it won't dictate the upward value of gold and silver in the future. And that's due to the demand I see coming due to energy constraints. But as we conclude here, one of the things you and I talk about, it's always trying to put the client first, or the person first, or the investor first, or the person who's reading the analysis. We're trying to do it the best we can for them. The frustration that you mentioned earlier on, what's happening now, especially when we had the big premiums? I know the Silver Eagles were going 50% premiums back in 2022. You were paying double. I'm not double. You're paying 50% more for that Silver Eagle. Now it's totally changed. Now the premiums have really collapsed. What What do you see going on? What do you see that frustrates you to some of these large dealers?
Yeah, I think that the large dealers, with the selling that started to take place last year, I think you started to see their bids really start to come apart. Meaning, what they were willing to buy these products back for. They talk about gold and silver as a store of value, as money, as one of the best investments out there. But what people don't understand is most of these dealers are just in business for themselves. At the end of the day, they're trying to make as much money as they can. And that's great. I totally get it. No one's here to provide charity and do it for free. I totally respect that. The problem is the marketing. The marketing unfortunately says you see a lot of this. We're the lowest cost, we're the lowest price dealer. We pay the highest premiums, or we pay the highest prices back when you want to go sell. We're selling, near metal value. All these sort of catchphrases, and it even gets worse. And this is the big online guys. It gets even worse when you start looking at these California gold dealers that sell these fractional gold coins and these fractional silver coins, the half ounce gold and the 1.5 ounce silver coins, with these 60% markups that have taken place over the last 5 years or so. Unfortunately, people may not be aware of the marketing practices of the industry, and there is literally no fiduciary concern whatsoever for the client's well-being. And there doesn't have to be. It's an unregulated environment for the most part. So what you see on a gold dealer on a YouTube podcast promoting gold and silver, and they're the best out there, they're A+ rated, they have no complaints or whatever it may be.
Mhm.
They can say whatever they want. There's no body out there that says, listen, you can't say that. Unlike the financial services industry, like, I'm a registered investment advisor. I can't just come out and say half this stuff because, I'm regulated. I'm overseen by a regulator. I have to stay within, I have compliance, I have fiduciary capacity. You know, I have to work on a best interest basis for my client. You don't have that. And so, one of the things I know we were kind of discovering, which we could talk about maybe at a later time, is the Better Business
Mhm.
Bureau and sort of the unfortunate um, confusion that the public sort of has with the look of a Better Business Bureau rating versus what that rating really means. Unfortunately, when they see A+, it's not like this is a gold and precious metals dealer that has a halo above its head. This just means that they have done a job that they needed to maintain the A+ rating, which means they could have, like you were mentioning, they could have 100 complaints, but as long as they're reacting to each one of those complaints saying, hey, listen, we'll get back to you, they can maintain that A+ rating. And I think most people need to take, when they see A+ accreditation through the Better Business Bureau, I think they need to remove the word accreditation and put in membership. And so
Right.
you can get a really much more, it's not like FINRA, it's not like the SEC when you go into a broker check or an investment advisor check and you can see, do they have any, uh, uh, what kind of past do they have? Do they have any regulatory issues? Do they have any disciplinary actions, things like that? That's not what Better Business Bureau really watches for. In fact, if you're using that, you got to be really careful because when everything does hit the fan with a company, the last place that'll probably show up will be the Better Business Bureau. Unfortunately, that's when the company stops, uh, you know, reacting to these complaints on Better Business Bureau, and then the complaints just overwhelm, uh, uh, that platform.
Yeah, no, there's Bob, there's plenty to talk about. And that's why I want to do more, these chats with you because we talk on the phone and there's a lot of things happening in the markets, in the industry, in the bullion industry. It's quite fascinating. You can't do it all in one interview, one chat. But yeah, I found out with the Better Business Bureau, if you're the company and you just reply to a complaint, you have met the A+ You don't have to solve the problem. All you have to do is reply. We're sorry. So the thing is, there's a lot of things going on. There's a lot of things in the industry that I think investors need to know. So, but before we leave, is there anything else that we didn't talk about today that you would like to end up on?
Yeah, I think we'll get into more down the road. I think the biggest thing right now is just investors trying to maintain some degree of uh, realistic outlook on the metals. And if they're in mining stocks, remember, mining stocks can become a trade more than a store of value, so to speak. I mean, they obviously can outperform the metals to the upside, but they can also have that same outperformance to the downside. So I think people have to have a tempered expectation when they get into the precious metals. You look at it more on a long-term basis. It's not going to be this get-rich-quick type of a type of investment vehicle. But there are times when the metals do have a good run, which we're in now. But just have that expectation of, hey, listen, this is just part of a portfolio strategy. If I'm buying it for the long term, think of it as a long-term investment, because there's going to be volatility. And I'll try and do my best to try to point this stuff out, on X and so forth. But just try to stay out of leverage. Those are the types of things that when you get these big market corrections, can wipe people out very quickly.
Yeah, and we've seen it. And the funny thing is, you just don't know until you're in the rearview mirror. If we all think it's just going to keep going up forever, but at some point in time, you get a correction, and the corrections are usually healthy. You have the correction, and then you start the next leg higher. And I think the next leg higher is going to be a big next leg higher. But so, Bob, well, thanks for joining me. I know you're on Twitter. First, I'll put your links to the Idaho Armored Vaults, and then your Twitter feed, and also you've got a new YouTube channel where you're doing some of your podcast yourself, and I think you're going to continue to do that. So I'll put that in the bottom. So I hope hope everyone enjoyed the information. If you have any questions, leave those in the comment section, and we'll answer those. Well, thank you very much, and Bob, have a good day.
You too.